My name is Jerome Schneider, and I'm head of short-term portfolio strategies here at PIMCO. With the Federal Reserve looking to increase interest rates over the foreseeable future, we believe that the front end of the yield curve of the U.S. bond market is a place to possibly consider for several different reasons. First of all, there's a potential for positive absolute return within the front-end universe. With short-term strategies really focused on the front end of the yield curve, their interest rate composition can be ranging from 0 to 1 year. In fact, in the current yield curve environment, short-term treasuries can withstand a recalibration to higher rates, and that's just simply because of where yields are at the front end of the yield curve right now. The composition of higher rates, and more importantly, the diversity of portfolio composition across a variety of high-quality assets in the investment grade, including treasuries, corporates, and structured products, make the potential for absolute returns likely over the foreseeable future. The second element is low volatility. In a volatility landscape that is gently increasing over the next few quarters as a result of changing central bank policy, investors need to be focused on volatility management as well. With equity volatilities historically about 15% or so, and longer duration fixed income portfolios offering a volatility of around 10%, short-term bonds offer a volatility of 1% or less per annum historically. The third element is simply looking to capture higher rates going forward, and specifically looking at higher LIBOR rates or credit-sensitive rates in the short-term space. As a result, we've been having higher allocations in our short-term portfolios that help to embrace those higher rates going forward. For us, higher LIBOR rates ultimately means that we're being paid a higher compensation for potential credit risk. Next, positive real return is something that we should be considering for portfolio positioning. Over the past 10 years or so, investors have really not begun to think about the impact of inflation on returns. But now with CPI increasing over the secular horizon, we need to really be thinking about the potential for impacts of inflation. Real return, effectively inflation-adjusted returns, is something that short-term portfolio investors simply haven't been paying attention to. So as we think about increasing inflation, the goal of a portfolio should also be not just nominal returns, but positive real returns. With short-term bonds yielding 2 to 2.5% or more, positive real returns is something that's potentially in the cards for investors to help shield them from the increasing inflation metrics we see. Finally, the cost of liquidity is an element of composition that we need to be thinking about for portfolio positions, and specifically being opportunistic. For short-term portfolios, there's a low cost of liquidity because the bonds that we hold are relatively short-dated. As a result, this is a relatively low-cost place for you to manage your liquidity over the foreseeable future. With monetary policy changing over the next few quarters, and more importantly, global monetary policy changing outside the United States, investors need to be more and more cognizant of these changes on the impact of volatility and, more importantly, rate increases in their portfolio. For investors focused on capital preservation and reducing that volatility while earning some income, we believe that the front end of the yield curve of the U.S. bond market is a place to possibly consider that balance between liquidity, capital preservation, and ultimately income.